Welcome back. We've been discussing the nearly unprecedented rise in US 10-year bond yields with three top-notch economists, Aditya, Bhave of Bank of America's, Robert Sockin of Citi, and Brian Coulton of Fitch Ratings. Gentlemen, thank you for your patience. Robert, two quick questions. What is Citi's view of, where the 10-year yield will be? Will it be above 5, and for how long? And can there be some accident consequences of people not being able to roll over their debt and therefore big defaults?
I think on this issue of can you go above 5%, I think the market's telling you you're getting pretty close, and it really comes down to these two issues we're talking about. How much are they going to bake in monetary policy expectations, and how much is the term premium going to go up? I think at these levels, if you're going to get to something like a 5% plus on the 10-year, unless term premium is significantly higher, it means that the markets are thinking that the Fed is going to stay with a policy rate, let's say well above 4 for the foreseeable future for the next 10 years. That seems very aggressive to us. That would be, a pretty restrictive policy. Given that we don't think, in our view, our stars moved up very much. And so putting that together, I'd be surprised if it moved above 5 on a sustainable basis. But, maybe, as I said, maybe that the term premium really is moving up very significantly and you can move above those levels. I think if you get there, to your second point, that is a pretty substantial tightening in financial conditions. These long rates are going to work into the economy through company borrowing and through consumer borrowing. And I think if you start to get above 5, you might start to hear Fed officials maybe start to be a bit more concerned, maybe even starting to push back on this. And it puts into question whether they want to or need to do any more hikes, given that that's a pretty substantial tightening in the interest rate that really starts to affect the economy even more impactfully than their increase in short rates. So I do think you could get above 5. I question if that can be sustainable. And then I think once you get there, if you do, I think the Fed's going to start to get a little more worried about the type of moves that we've had.
Your thoughts, Aditya, your yield trajectory or range for the next 6 months, say, and this accidents, when do the loans get reset? And therefore, any potential accidents in 24?
Right. So in terms of the near-term trajectory, our strategists do see a risk that the 10-year could go above 5%. Whether it could stay there is a bigger question. They do think that there's going to be significant resistance around the 5% level, so it might be difficult to break 5% and stay there. In terms of the risks of something breaking, those risks are probably pretty salient even at these levels, right? You don't need to get to 5% or higher. I would highlight that consumer balance sheets are pretty well set up to deal with these sort of risks, and also that because of the prevalence of the 30-year fixed rate mortgage in the US, consumers are not that exposed to higher rates. Right? So mortgage debt makes up about 70% of total consumer debt, and a very large share of households are they either took out mortgages at a very low rate or they refinanced when the Fed cut to zero in those two episodes in 2009, 2010, and 2021. They refinanced to much lower rates. So the effective mortgage rate in the US, the average rate that people are paying on their mortgages, has only increased about 25 basis points, and it still remains very low by historical standards, even though the spot mortgage rate is much, much higher, right? It's increased by about 400 basis points. And then on the business side, I would be a little bit more concerned. There is a wall of refinancing coming up in commercial real estate, in kind of high yield stuff that would be more of a 2024, 2025 story. So we'll see where rates are by then, but that is something to watch for. And yes, something could break. And as Robert said, if there are risks that something breaks, then the Fed pushes back, which again raises questions about how long we can really sustain these higher rates.
Okay. Time permitting, I'll ask you as well, Brian, about whether a large part of the US consumer and companies have become rate insensitive because their loans are at fixed rates. But before that, I want to cover the impact on emerging markets. Do you think the US yields being where they are actually restricts a lot of emerging markets from loosening their policies. Countries like India, for instance, simply because you're so scared that dollars will run away.
I'm not sure it's such a constraint necessarily on monetary easing. I mean, I think as long as we don't see a kind of renewed surge in global food and energy prices, which were a really big deal for a lot of emerging market central banks a year or so ago, as long as that doesn't happen, I do think that the emerging markets moved quick enough and ahead of the Fed in raising rates that they've now opened up some space to cut rates. Now, obviously, the US rates staying higher means potentially more downward pressure on currencies if they do that. But as long as, say, oil and food prices don't sort of surge again, it's not necessarily a big constraint. I think there's a broader issue on just overall dollar funding costs globally are going to be much higher. And I do wonder if we're at the point now with the yield this close to 5%, where we're going to start to see a little bit more upward pressure on risk spreads than we've seen so far.
Very quickly, a last question to you, Robert. Do you think the fact that, as Aditya said, a large part of the consumer is insulated because mortgage debt is fixed rates in the US, does that mean that the Fed will have to raise more to get the impact?
Yeah, it's a great question and a set of points. And I think, to that point, if you look at consumer balance sheets, very healthy by many metrics. Net worth is very high. We just had massive revisions to the savings rate in the US last week that effectively boosted all estimates of excess savings from COVID, and also raised current savings rates that make them look closer to where they were pre-pandemic. So the consumer is looking like its balance sheet's healthy, it could stably continue to spend. That alone, I think, puts upside risk to growth and upside risk to inflation. And if you look again at overall debt service costs, as we were discussing earlier, they're still very healthy and at pretty low, running around pre-COVID levels. So you're not really seeing these interest rates impact the consumer in a meaningful way, particularly given this mortgage issue. I do think there are pockets that are getting impacted a bit more. I think on the lower end consumer, which leans more on credit card debt, you've seen that pick up some. It's still relatively okay relative to income. Those are getting hit by higher rates. So you are seeing in some segments, but I would agree overall that the balance of risks are that the consumer is pretty insulated from these effects, and that they're going to maintain a lot of strength. And that could mean the Fed does have to do more, or at a minimum, just hang out where they are and hold that for longer. So I think that's the crux of this higher for longer narrative. It's the strong consumer. Okay.
Aditya, quickly, any takeaway for emerging markets here?
Look, I think it's a point of concern, right? What's unusual about the US is when there are concerns about the deficit, the currency doesn't get impacted. In fact, the currency moves the other way. As yields go up, the dollar strengthens, and that obviously poses some challenges for emerging markets. So, hopefully for emerging markets, this sell-off in yields doesn't last for a long time. But if it does, I guess, fasten your seatbelts, because it's obviously having a big impact on risky assets, and EM debt as well as EM equities would fall into that basket of risky assets, right?
Okay, Brian, 10 seconds. What's your biggest concern now?
I think for markets, it's the point that the other guys have made, that the consumer just stays strong, and the Fed is not done with one more hike. They feel they have to do another 2 or 3. I think that takes us above 5%. I don't know how long we stay there. I think we probably get a deeper recession after that. That looked pretty ugly, and that would have a big impact on risk assets.
Okay. Gentlemen, thank you very much for joining me. As you can see, these are experts, and there are still a lot of ifs and buts from them on exactly how deep can the recession be, how long can the yields stay above 5% on the 10-year if they do get there. So lots of ifs and buts over here, but consequences can be nasty if yields stay long and high for a very long time. On that note, we wrap up on this edition of Indianomics. Thank you very much for watching.